So ever since my financial epiphany that I had last week, in which I finally started to understand what Jeff Snyder has been talking about for years with regard to the repo market and this whole problem of collateral and all this. These are things that I've heard, that I heard the guy talk about for many years, and I never could quite wrap my head around until it finally clicked this weekend. And what I'm starting to understand is that, I'm not 100% ready to just say, oh, I accept his explanation of everything. I'm far from that. But I'm in trying to understand what he's talking about. What he is describing is a monetary regime that is completely different from what most people who study monetary theory at all, or study, the monetary economics of the United States, it's a completely different system than what we think exists, or what we're taught, in economics classes, or just what common sense would teach you. And to lay that out, the traditional monetary system, as we think of it, the fractional reserve banking system, works like this. You have banks that accept deposits in the form of base money. These are the dollars that are created by the Fed, or minted, by the U.S. Mint. These are all your dollar bills and your coins and all this, and you take them to the bank, and you deposit them in the bank, and the bank lends them out. All the while, though, while the bank has your money lent out, they also owe you that money. So your money exists in two places at once. And this is what's this is the basis of the fractional reserve banking system. Your money is both being used to be lent out, let's say, to your neighbor, so that they can purchase a home, and at the same time, the bank owes that money to you. These deposits are leveraged. They exist in more than one place at once. And the limit on how much these deposits could be leveraged, when you consider that the bank, what they do, the way that the bank creates money out of thin air, is that they essentially create more demand deposits. They create, two sets of your money, two claims to the same amount of money. These claims then can make their way to other banks and such, and you end up with this very complex pyramid to where you have a whole lot of bank-created claims to money that are all backed up by a relatively small quantity of base money. And the general rule of thumb, what the old minimum reserve ratio for banks was around 10%. And so you would expect that we have this supply of base money that is controlled directly by the Federal Reserve. This is the money that the Fed prints. When we talk about the Fed printing money, they print base money, and that is leveraged up 10 times by the commercial banking system, and that is how that's our money supply. That's what the supply of money is in the the U.S. dollar economy. But without getting into too many details over the years, there has been a lot of signs to me to where that explanation just has not explained the entire story. It doesn't explain the levels of inflation that or the lack of levels of inflation that we've seen over the past few years. It doesn't explain directly asset prices. So, for example, once I realized that, QE is not creating high levels of consumer price inflation, we're not seeing as much inflation as we would expect from the amount of money that the Fed is printing, because, of course, the Fed has printed so much money over the last 10 years that I've witnessed, and yet these spikes in inflation don't at all appear to be directly correlated to as much money as we're seeing created, supposedly. And so that was the first thing that made me second guess the traditional understanding of the fractional reserve banking monetary system. I had to say to myself, well, gee, why isn't all this new money that's been created showing up in the real economy in the form of increases in consumer prices? Yeah, consumer prices go up every year. They certainly never go down. The cost of living goes up all the time, but it's not going up nearly as much as you would expect. So where's all this money going? And eventually came to the conclusion, like so many people, oh, well, it's going into asset prices. Obviously, bonds, stocks, and real estate way overvalued, and they go up every year. They go up, um, double-digit percentages every year. Well, if that's the case, how is the money getting directly? What is the transmission mechanism for the monetary policy? If the Fed's monetary policy is driving up asset prices and not consumer prices, and all it's doing is having the effect of mostly driving up asset prices while having a relatively much smaller effect on consumer prices, how does that work? Because if the Fed is just pumping the banks full of reserves, you would expect that the banks would, lend those out. Yes, in terms of mortgages, the banks don't lend and directly boost the stock market that way, right? And so it provided sort of an incomplete picture for me. There's still a something that I felt like I was missing. And then the other thing was that, well, the Fed is buying up all of these lower risk, lower interest rate bonds, driving down the interest rates of treasuries and mortgage-backed securities. And so that pushes people who otherwise would have purchased those securities out the risk curve, into higher risk assets, so that they can chase yield. But even that seems like an insufficient explanation, because that to me does not explain the seemingly bottomless appetite for risk assets. It does not explain how prices go up year after year if all the Fed is doing essentially is cannibalizing the low end of the risk curve and pushing out people further out the risk curve. That's sort of a fixed pie, if you will, because if we're talking about, oh, well, these are people who have money who want to invest it somewhere, and the Fed is just pushing them out the risk curve, the Fed is not growing the pie of investors. How is it that interest rates have been this low for this long? The people who were going to be pushed out the risk curve were pushed out there a long time ago. How is it that markets continue to grow, or the risk asset prices continue to grow at such a high rate year after year? The inflation, the newly created money, can't just be going into the bond market. There has to be some new money. There has to be money that's being created out of thin air that is going into stocks. And so that's where the repo market comes in. The repo market, I did not quite grasp, is used extensively, not just for overnight lending so that banks, can bring their balance sheets into compliances, and, well, it's not always compliance, so that they can sort of shore up their balance sheet day to day. If they say, at the end of the day, they owe a little bit of money, or they have a little excess cash, on their balance sheet that they don't need, so that they can shift that around and make sure that they remain solvent on a daily basis. That's what I thought repo markets were. You have banks that have a little extra money at the end of the day, lending money overnight to banks who had a little less money than they needed at the end of the day, who owed money at the end of the day. But according to Jeff Snyder, that is not the case. The repo market is also used by whatever you want to call them, shadow banks, investment banks, private equity firms, hedge funds, and the like, all these sorts of entities. The repo market is used in order to facilitate leveraged asset purchases. And in the repo market, bank reserves like we talked about with traditional fractional reserve banking, are not used. The monetary base in this situation is actually U.S. Treasuries. And so instead of leveraging bank reserves 10 times in order to lend out, and create 10 times as much money and lend that out to people in the real economy to invest in businesses or to buy homes or do whatever, the repo market is leveraging U.S. Treasuries up to 30 times in order to purchase risk assets. And so this is an entire space of money production that I had never considered. And it certainly more than would explain the great inflation in risk assets, particularly stocks and junk bonds. And so the inflation that we have seen in recent years, and who knows how far back you could take this, but for a long time, the inflation that we're seeing is not coming from leveraging bank deposits and bank reserves in order to lend into the real economy. We're not seeing a great expansion of money through that channel. Where we are seeing an expansion of money, an expansion of credit, is in the repo market, where money is created out of thin air in order to purchase securities. So what's so interesting about this is that when you look at things through this perspective, all of a sudden it appears that the Federal Reserve has a lot less influence over the economy and over financial markets than we once thought or would think intuitively, based off of what common knowledge people who study financial markets in depth typically have. Because the Fed is a pretty remote player in this space that I'm describing. Because the Fed is neither issuing the base money, nor are they the ones, lending credit. If we think about money as an inverted pyramid, the traditional fractional reserve system, we think of, okay, well, there's a 10% base of dollars, and that the supply of that base is controlled by the central bank, and the banks, we know, are just going to completely, lever up as much as they can, because banks, want to make as much money as they can and lend as much as they can. And so we assume that the more that the Federal Reserve pumps reserves into the banking system, the more they will lend out, and thus the greater supply of broad money. That's why people assume that as soon as the Fed announces, oh, we're going to expand our balance sheet, which means, print base money, print bank reserves, people assume that means there's going to be some increase in consumer price inflation, because it is assumed that that money that the Fed injects into the banks is going to be levered up. But in the repo market, however, the Fed bank reserves are not what's being levered up there. It's treasuries, and the Fed does not create or issue treasury bonds. And when you realize that, certain things start to make more sense. For example, something I just thought of, and I haven't thought through the total implications of this yet. I'm going through this stuff as I think of it. I'm brainstorming, trying to understand the implications of this. You understand why banks might not completely lever themselves up and lend out as much as they can, considering the amount of reserves that they're sitting on. If they can make more money dealing with financial markets, which the way that they involve themselves in financial markets is through repo, not through traditional commercial banking. It's not through making loans to businesses or or traditional forms of lending that we think of, because there's so little growth in the U.S. economy. That doesn't make sense. But where is there growth? There's growth in the price of financial assets. And so I think part of the story here is that banks are not dependent on traditional commercial banking anymore to make money. They are able to make money through financialization, which is tied to the repo market. And so therefore, you pump more bank reserves into the banks, and they don't have much use for them. What they want are reserves that they can use to lever themselves up in the repo market. Think about it this way: if you were a bank, would you spend your time and your manpower levering up bank reserves 10 times to think of it this way, to purchase assets, because that's kind of what you're doing when they make a loan, to purchase an asset that's yielding, 3%? Or would you rather spend your time in the repo market, where you can take an asset, a treasury, not a bank reserve, lever that up 30 times in order to purchase assets that are yielding 6%? I think that's really what's key here, is that we're so distracted trying to look for traditional bank lending, which results in an expansion, it results in economic bubbles across all sectors of the real economy. Whereas what we need to be focused on, where the inflation is going to come, let me start over. In a traditional boom-bust cycle within the Austrian business cycle framework, banks take the base money that they have, the bank reserves, they expand that supply of money by extending credit to businesses and individuals in the real economy. The real economy has a short-term sugar rush, which eventually leads to price adjustments, because the sugar rush is from an injection of new money, not necessarily an increase in productivity. And so therefore, we get inflation in the real economy. We get consumer price inflation. But all we've seen since the end of the financial crisis in the United States is a stagnation of the economy. Very little growth. I mean, we're not totally flat, but it's low. We have anemic growth in the U.S. economy. Yet asset prices have exploded year after year after year. It's the longest bull market in American history. And so what would explain that is that all of this credit expansion has not been going on in the commercial banking system. It's been going on in the repo market of rehypothecated collateral. A market in which we can see the same treasury bond borrowed against 30 times to go out and purchase stocks and junk bonds and other high-yielding assets. And so instead of our current bubble being fueled by the Fed creating bank reserves and injecting that into the commercial banks, and enabling them to expand credit through traditional fractional reserve banking, what we're actually seeing is that credit expansion is being enabled by U.S. government deficits. As odd as that sounds, it's hard for me to even say this because it seems so counterintuitive. But in the repo market system, treasuries are functioning as the monetary base. And as I say, my definition of money since I was in college has always been that money is the most liquid asset in a market. And in the repo market, there's nothing more liquid than U.S. treasuries, it would appear. And so the bubble that we've witnessed being blown over the last, more than a decade is not being fueled by quantitative easing. The Fed creating bank reserves to buy treasuries, may not be the source of the, may not be what is ratcheting up the bubble, may not be where the air is coming in from. Instead, federal debt is the source of the bubble. That is, the federal government appears, and again, there's so much that this is such an opaque space, it's hard for me to say anything definitive, but it appears that the federal government has superseded the role of the Fed in the expansion of the money supply. But at the same time, this is only possible because of the Fed, because there is an understanding that the Fed will always come in and put a floor in treasuries, and that the U.S. government will never be allowed to default because the Fed will just print money to buy up the treasuries if the U.S. government doesn't have the money to pay back its debts. That's why, on an overnight basis, U.S. treasuries are considered to be a risk-free asset and therefore pristine collateral. Because from day to day, people know that they're not going to lose money. So there's a lot that I still have to think through on this, but it helps me to sort of do it out loud. And I appreciate anyone who's coming along with me for the journey. And if you have any questions or suggestions or things to add, please do leave that down below, because I will find that very helpful. I'm not one of these people who ask people to comment just for the algorithm. I ask people for comments when I want comments. I want to try and understand what's going on, because if I can work through these things and I can really master my understanding of what I discussed today, then I can start to apply that more broadly. Oh, and by the way, for anyone who's freaked out by the idea of treasuries being money, there is precedent for this in Mises's Theory of Money and Credit from 1912, page 59. I looked it up today. He mentions briefly the concept of credit money. He might get into it a little more deeper later in the chapter. But on page 59, he does mention, he brings it up and describes, credit money as just, a debt instrument, which is not redeemable on demand. So he does that to distinguish it from demand deposits, which are a form of, in our system, a fiat money substitute. And so credit money is not just a money substitute. It is its own class of money, like commodity money or fiat money. Now, before I go, one last thing. The problem with this system, from, let's say, the Fed's perspective or Wall Street's perspective, is that the Fed can't just come in and keep pumping up the money supply. The Fed can't just keep pumping in more money on their own. They need Congress to run deficits so that they can issue more treasuries for people to borrow against in the repo market and to lever up 30 times in order to increase the money supply in financial markets, so that they can purchase more junk bonds and more stocks, so that for example, junk bond market needs to keep going up, or else all of these zombie corporations are going to roll over and go bankrupt. I've laid out in previous videos, before this, this recent episode, my recent epiphany, why it's imperative that the bubble can't just, why credit must continue to expand, why it can't just stay as it is, why we need constant new injections of new money in order to keep the bubble, growing. If it's not growing, it's shrinking, in other words. And if it's shrinking, it most likely will start to collapse in on itself. And this is something that, in the context of the repo market, Jeff has been explaining very well, and is not all that different from how you would, from what your understanding would be of a financial deleveraging, in any other context, even getting rid of the whole repo market idea. But just to review, if all of a sudden there isn't as much federal debt, if there's not a growing supply of federal debt, financial institutions may not have sufficient pristine collateral in order to finance their leveraged securities purchases, and they will have to start unwinding some of those positions. They'll have to start selling things like stocks and bonds, and when they do that, it of course is going to have a cascading effect, because they won't be the only ones who are experiencing a collateral shortage. It won't be an isolated incident, it will be a systemic issue. And so there will be a certain tranche, let's say, of the repo market that has to begin liquidating their positions. And when that happens, we get liquidations which, in the short run can lead to illiquid markets, because there's too many there's too many sellers, at a given time for a given asset. And the bigger the collateral shortage, the bigger the sell-off will be. So that's about as far through as I've thought this all out. I'm sure I will continue to think more about this and to do more research and to come to greater understandings, a deeper understanding of the issue, and I will continue to try and talk through that on here, because it's going to likely alter my outlook for this current bubble and the direction that we have been moving, in the direction that we'll continue to move, and what the nature of the eventual economic unwinding will be. So, with that said, I will see you folks back here tomorrow.